So I welcome all of you to this event. So on behalf of Smart Finance, I welcome you all for this event. So as a registered member of our website, you are eligible for this program and we have been sending you the emails periodically on this particular event. And this is not the rarest of the event. Very frequently we conduct the events, educative events. So by this process, we introduce ourselves to you and you also learn some new concepts. So as a entity, as a company, as a business, we are located in Chennai and our core activities is to do research in this field of technical analysis, and by this process we have innovated many new concepts. Many people say about the research, however, what is a real research? When you do something and find out something new, that is called a research. So when we say about the research, that means you found out something new which was not there and which others can able to implement and get benefit out of that. So technical analysis study, there was 3,500 indicators, 13 to 14 different type of charts, line chart, bar chart, candle chart, like that 13 to 14 different of charting technique was there, and many fundamental concepts to analyze a stock, analyze a company. Those are the things was there. So what was the emergency we feel so that we can able to introduce some new concept? We found out that most of these indicators, whatever is present or whatever these charting techniques are present, they are just doing the postmortem of the data or postmortem of the event which has already happened. So when we talk about the past data and based on that we do some addition, subtraction, something, and we just give you some outcome, that is just a postmortem of the data. It doesn't give anything to the future anticipation. So here we are going for a future forecast or future prediction or future calculation based on a past data. So that is the lacking in all these technical methods. And charting technique is nothing but it is just putting whatever the data you are giving, it is just plotting it in a graph sheet. Whatever the data you have given, so it has drawn some candles and shown you, drawn some points and shown you the lines, all these things. So it was the emergency need for a trader that they should know a true forecast method by means of which they can able to calculate the average trader's view well in advance and project the price movement. So by this process, many years have gone. Our establishment is 14 to 15 years. And in the past 15 years, many things we have come across. And in this process, we have just innovated a concept called volatility. So this we have found out that this is the very definition of volatility. It says that uncertainty at a particular time. Volatility is nothing but again it is the anticipation or the fear factor at a particular time. So mathematically we have exploited it and we have just included this method into different existing technical parameters, technical studies, and we give you the wonderful result. So this event what today I am going to conduct, this is on the how we can accommodate the factor of volatility into the Elliot wave. So that is what our study is. Today you are going to learn that. So this event will be, I think it is 135-37 people have registered. So this event will be witnessed by your 200 plus people. So I'll be starting the event at 8:30 as I told you. So you will be learning how you can utilize this Elliott wave analysis for your short-term investment objective. That is the concept you are going to learn in this event. So great festival of Navaratri is starting today, and it is a great day to learn. So knowingly I have scheduled this event. So, and in between this particular event, if you have any query, put it in the chat box. If the time permits, I will attend it. So what are the things we are going to learn? Elliott wave structure, Elliott wave pattern and trade using the same, and investment. How we can do a short-term investment using the Elliott wave analysis, along with the one standard deviation. Because I told you we will be accommodating the volatility into the Elliott study. So this is our research. This is our unique research. How we will accommodate the volatility into the Elliott study, that I am going to explain. And in the smart finance domain, if you are having the Elliott wave course, you can learn the same things. This book and DVD, if you have, many of you are buyers. If you have this, post this event, try to learn as much as possible. So here, once we are talking about Elliott wave, it is just a pattern divided into two categories. One is a impulsive category, other one is a corrective category. Elliott wave, Elliot has told the impulsive pattern has 5 waves, 1, 2, 3, 4, 5 he has given. So wherein the second wave and fourth wave is the opposite direction of the trend. 1, 3 and 5 are the same direction of the trend. Corrective pattern, he has given ABC name. So very easy names he has kept it. So here this concept of Elliott wave emerges from the harmonic nature of the price. So what is the harmonic nature of the price? Any stock price which is going up, it has all probability to fall down. Same way, any stock price which is falling down has the all probability to go up. So financial instruments pricing is not permanent. It is going to correct and it is going to grow. So the correction and growth nature of the price of any instrument defines the harmonic nature. So like your pendulum, you can say pendulum clock, from here you are knowing that simple harmonic. So it moves between two endpoints. So as long as energy is there, it will be moving between 2 points. So that says that as long as the demand and price is there, the price is going to, demand and supply is there. So price is going to move between a low and high. So low you can define to 0. It should not be negative. High is infinity. So high can go to any extent. So this is what is there. No life ending point is there. No life ending point is there for a wave structure. That's why it is harmonic. So coming to this wave structure. So this is how the impulsive wave pattern looks like. Wave 1, wave 2 is a corrective. Wave 3 is the biggest wave. Wave 4 again corrective. Wave 5 again goes up. So that doesn't mean that this impulsive pattern happens in the upward only, never happens in the downward. So here, whenever the price of, very key information this one, whenever the price of any instrument goes up along with the growth in the volume, if the price rises with minimum 10 to 15% growth in the volume as compared to its past 10 days average volume, then you can say that it is following a rising impulsive wave pattern. Same way, if the price fall along with the volume, rise in the volume, price fall with the rise in the volume, that is 10 to 15% higher than its 10 days average value, then also you can say that the downward impulsive wave. If the price rise, along with a small growth or no growth in the volume, very small growth, 1 or 2% growth in the volume, or 0% growth in the volume, or lesser than the 10 days average volume, that time we can say that it is a upward corrective wave action. Upward corrective wave action. Same way, if the price goes up, price fallen down. So if same way the price fallen down along with low volume or negative growth in the volume, then also we can say that downward corrective wave. So this is how you should understand impulsive wave, corrective wave, two category: upward impulsive, downward impulsive. Upward corrective, downward corrective, that is it purely depend upon the volume. In the book you can find it out. This is the definition of wave 1. It has many other rules. I told you, ignore the rules, first understand the wave. So, as I told, when this volume is increasing along with the price is increasing, you are going to use the impulsive wave, upward impulsive wave. Price is falling, volume is increasing, downward impulsive wave. Price is increasing and the volume is decreasing or lesser, than upward corrective wave, and same way. So this is what I have told you. So 2 times I have repeated the same. 0.618 of the wave 1, opposite direction. It is the retracement of wave 1. If wave 1 is a rising, wave 2 should be falling. If wave 1 is a falling wave, wave 2 will be rising. And it also has an expansion. 0.618 to 0.786 expansion also there. Wave 3, this is 1.236 of wave 1. It extends faster degree extension 1.618, and it also extends by a 2% of retracement of wave 1 in the second degree expansion. So this is also there. Wave 4, 0.618 retracement of wave 3. Whatever wave 3 has given, 0.618 times it should retrace. Wave 5, it is the critical wave. So it initially is the same length as wave 1. It expands till 1.618, which is faster degree. Second degree expansion is 1.618. So this is what the impulsive wave pattern is. Same way corrective wave pattern. I will show you in an Excel sheet. Corrective wave pattern, wave A, B and C. Fibonacci ratios 0.618 of the prior swing, and it must be against the prior trend. It must be against the prior trend. That is also one of the rule. Wave B, 0.618 retracement of wave A, and it has an extension till 1.236. Wave C, either 1.618 of wave A or 2.618 of wave A. This is what this wave definition is. This is how the wave is being plotted. Now come to these patterns. How, as a trader, how we can use? We can utilize it for identifying the trend. Where we should buy or sell? We have only 2 points to buy or sell. Impulsive cycle if we are following, then wave 3 starting point or wave 4 ending point. This is the 2 points we should enter. If it is a rising impulsive, we should buy. If it is a falling impulsive, we must sell. So these are the points we should make an entry for the buy or sell. If it is a corrective pattern, then buy sell entry happens at the wave B end point. And when a wave considered to be a failure or a complex correction. So this wave pattern once started means 1, 2, 3, 4 started means it will complete. There is no certainty. It may fail also. It may fail also. So once the impulsive pattern started, it doesn't guarantee that it will complete. It may fail also. So the failing happens if it fails to achieve 0.618 or 61% of its targeted journey. Whatever the amount of price escalation or fall it is expected, if it fails to achieve 61.8% of its targeted journey, it is a failure. So I can say it is a beautiful way of using the Fibonacci ratio for a trend forecast. It is nothing but using the Fibonacci ratio with some rules and validations. So that is only known as your wave pattern. And if it fails to achieve 38.382 target journey, so this also consider as a failure. So sometimes we can say it is a failure, sometimes we can say it is a complex correction. So once such kind of things happens, then what we need to do? So there is a principle Elliot has given, we have to do the channeling. So channeling is a advanced concept. In your free time, you can try to explore something in the web search and other things and find out what is channeling, how I can do web channeling. So if you search, you will get a lot of information. If such kind of things happens, then this is what we have to do. And once we are going to invest, so today's decorum is we are going to learn some short-term investment techniques. So once we are going to invest in a stock, so we have to find out, watch out a measure low and high in a period which matches your holding period. Suppose you are going to do for 7 days. In that 7 days, what is the high and low? This is the static principle. We will go for the volatility way. So where high and low we do not know or we do not want at all. So in 7 days, what is the high and low? Draw both impulsive and corrective way using these rules, whatever I have told. Watch out for correction or a complex correction. So once this wave 2 correction happened or wave 4 will be a complex correction happened, then invest at the end of complex correction trigger point. So this is what it says. So this is the 4 steps to invest using the Elliot wave. Looks little complicated, however it is not like that. These 4 points once you read, you may be thinking that it is looking very complicated, that complex correction, how I will find it out, how I will be finding out these rules and all. So both the things I have to plot, then only I have to decide. Not many mind-boggling things I have to do. It is not such. It is very easy, very, very easy. Because this high and low factor I am just eliminating. I am telling that take the volatility, take the one standard deviation, which is more accurate as compared to this high and low. Previously, some high and low happened. It may be because of a spike, because of a sudden temporary demand. So do not go by that. Just go for a one standard deviation study. So that will be more appropriate. So move to the one standard deviation. What it says? One standard deviation says that annual volatility into price into square root of number of days what you are going to hold divided by square root of 365. You will get a price range. Once you get a price range, then all your wave studies will be perfect. So there are two ways. Either if you have any advanced software, then just look into specific Elliot tools which can draw those things for you, or else you just go for a calculation. So I am just going to take some calculations for this thing. I am just going for NSE site, NSEindia.com. I'll be just taking the equity. I am taking, or I'm going for the stock future. I'm taking Davis Lab. It is giving a great volume growth. So impulsive, it qualifies. So here historic data. I'm just doing these things to demonstrate how you can choose, how you can identify whether I should use a impulsive pattern or a corrective pattern. Last 7 days data I'm taking. So I'm just seeing all this volume part. So volume 10 days, 7 days back, it was only 18,000 contract, moved to 21, 26, 48, just doubled, 45, very great growth in the volume. So this is a perfect candidate for your impulsive pattern. So you do not know whether it is a impulsive, upward impulsive or downward impulsive. We do not know so far. Current price is 991.70. This is where it is closed. I do not want previously what happened. So 991.70. This is the thing happened, and in fact there was a high happened during the day 998.95. So 998.85. I am just taking 999. Go back to the volatility part, fundamental. Here, other info. Annual volatility, great, 78%. 4% daily volatility, 78%. So annual volatility. So put the one standard deviation into action. So 78%. So 78% divided by 100. So 0.78. 78. So 0.78. So here. So I think this needs 78 only. Okay, we'll just multiply and find it out. First, price 991.7. Say we are going to do for 1 week. So, or 15 days. 15 days short term investment, very short term. So, this we are going for square root of 15 divided by square root of 365. This is what the one standard deviation formula says, 156 points. So I got this 156.81 points. So here I'm just going to substitute this one. 157 points is the value. So now your calculation started. So this is, I need a point from where I will start. I need a point from where I will start the calculation. Why should I take previous lows, highs, this, that? Why not the current price where it has stopped? Whatever happened previously, I am not going to take that. I am going to just concern the price from where it has stopped, 991.7. So this is what I have done, 991.7, 157. Price range, wave 1 I have drawn. So wave 1 is having 60 rupees. Wave 2, there will be a retracement from here to 1015, and if this retracement continues also, it can come till 977. This is, as I told you, wave 2 has a expansion. So wave 2 has a expansion. So this expansion goes to 0.786, 1005. Second degree expansion happened 977.5. Till this 977.5, wave 2 is not broken, wave 2 is not a failure. If till this point also, you can wait. So if it is ending at 977, then from there itself the calculation will start for the wave 3. So if it is successfully retraces to 1015 and from there it will again move up, then this is the 1015 point will be the price of my entry. And actual, it should go to 1089. First degree expansion 11 to 1112. Second degree expansion 1135. There is a retracement will happen. If from here it happened 1089 level, the wave 4 1043 level you can come. So if you have missed the trade here 1015, you have again a chance to enter at 1043. So if the first degree, second degree expansion happen, then accordingly you can draw the wave 4. Then wave 5. So wave 5, it has same way 1103. If there is a expansion, it can go to 1163. And one more rule is here, fantastic rule, very simple and very crisp rule for the Elliot wave study. It says if wave 3 is a expansion, then wave 5 also will be expansion. That means if wave 3 has gone for a first degree expansion or second degree expansion, then wave 5 also will become an expansion. So it is volumes are growing, so I'll be following price is going up along with the growth in the volume. So I'll be following the impulsive, rising impulsive now. So 991.7 I have started. So this is how it is going up. So there is a falling side also, because this is only a unidirectional way I have taken. So if you want the falling side, then you need to calculate also. So I'll just take the help of my software, Davis Lab. I am just going to load the data. I have taken the equity, nothing wrong. So there I have shown you for future. Here I am taking equity 15 days. 15 days, calculate. So Elliot studies. So Elliot studies. So here. So fine. So this is the actual. So it is just not reset. So that once it is reset, you will get a proper value. So here, wave 1, it is 950 level, it is starting. Wave 1. So now it goes to 1021. There is a correction. So here, impulsive having these two parts. These two parts. So rising wave, see here, many people will be getting confused here and they'll say that yes, here falling wave, it is telling that 999 to 928. However, rising wave, it is telling 950 to 10,021. We have just fixed up some rules here because of that only. So the starting point not necessarily it should be from the 991. So here we are just starting because this is server is not reset. So whatever today's analysis, it is coming here. Today's analysis, it is coming here. So once it is reset, tomorrow you will get a fresh level. So this is how it says. So here you have two values in your hand. One says 991 to 921. Again there is a growth. So here impulsive. So now you are at a 990 level. So 990 level. Those who have initiated this study in the morning. Imagine you have initiated this study in the morning hour, today's morning, for a positional 15 days. How you will take benefit of these calculations. So this gives you this particular analysis. Once you get this analysis, say morning it has opened off, it has gone specific level. Now things are being changed. So here I am an investor. I invested say around 950 or 960 level. I am just waiting for 1021 wave 1 to complete. Wave 1 to complete. So this says that wave 2 will be having a correction till 977. Then it can move till wave 3 1068. It will have a further correction. Then wave 5 expansion till 1160 it can take me. Or this is a falling sequence. So 1021 doesn't happen. Say it has not happened. It has corrected. So once it is corrected, wave 2. Suppose I have entered 960, 970, somewhere I have entered. It has not moved. It has come back. So where should I stop? So here the second table, falling sequence. Falling sequence, it says that. So here two prices will be matching. Almost it will be matching, say 972. So this rising wave, there is a corrective pattern at 977. Falling, same falling sequence, there is a corrective pattern till 972. So if you have entered, very carefully understand this pattern. If you have entered a trade, just wait till 972. If this 972 is broken, you entered somewhere 950, 960, wherever maybe it has gone up, now it is 991. From here, once it retraces back to 972, your hope will be diminished. You will not be moving in the impulsive, rising impulsive pattern. Maybe you are moving in the falling impulsive pattern. Look into the volume at that particular time. Once it is coming to 972 level, look into the volume at that particular time. If volume also almost equal or going above whatever the current volume is there, then you can still think of hedging it and holding, because the rising wave has not failed. If the volume is increased and price has come down to 972, after touching this 991 level and failed to touch this 1021 level, then better to come out. Two things I told you here very carefully. Again I will repeat. If after touching this level or after touching this 10,021 or before touching this level, if it is correct, come to 972 level, then you will be thinking that you will be into the falling wave, falling impulsive wave. And at that particular time, you have to introspect the volume. Falling impulsive wave will be a true scenario if there is zero growth in the volume or less growth in the volume. If volume also increased to a great extent, then you may think of waiting for some more time, or try to hedge at that particular time. So volume has not grown, so you can say that again you can come back to that rising impulsive. It can again give add on the volumes. However, if the volume also increased, then falling wave is a thing which can hit. So try to reverse your trade, and definitely you must hedge the trade. So this is how you can use. And while using it for the investment, better draw a scenario of 7 to 10 days. Every 7 days you should take a study. 6 to 7 days period is a great period. You should take a study. And as I told you, here for investment, you have two places. Watch out for a correction or a complex correction. If wave 2 correction, then wave 4 will be a complex correction, and enter. So here again I am going to this same Excel sheet. I am telling you here, wave 2 end point. This is the point, or it can expand further. Here. So wave 2 is a retracement happened, further corrected. Wave 2 is a correction, means wave 4 will be a complex correction, means wave 4 also will have a correction, say of the first degree or second degree. So once you have 2 points to enter, one is wave 2, another is the wave. So these 2 points you can enter, no other points. So this is what your Elliot waves concept with the one standard deviation. Only thing we have eliminated here, no high and low estimations we have taken. Taken the one standard deviation along with the one price of reference. The price of reference may be previous day's close. Price of reference may be today's close. Price of reference may be today's open. Any one thing it can choose. Or price of reference may be current price also. So any one thing which will dynamically you can choose. You can choose either current price, what is running now. You can use open price, but at what price the counter has opened for the day. Previous day's price also you can take. But better if you are going to invest, then better go for a current price or open price. That is the best, that is the most concurrent price. From there you can draw. And we have a fantastic calculator also available. If you do not have a paid tool, do not get disappointed that I do not have a tool, how I can utilize it. Next tool has specific benefits. However, you can give the high, low and current price here. Though volatility related benefits you cannot able to take. However, in this particular tool, just give the high, low and current price and trace the wave 1, 2, 3, 4, 5 and ABC. Only one thing you have to remember here, when I should use the impulsive pattern, when I should use the corrective pattern. Impulsive pattern must be used with the rise in the price, with rise in the volume, or fall in the price with fall in the volume. Fall in the price with the fall in the price with the rise in the volume. So rise in the volume. So fall in the price with rise in the volume, or rise in the price with rise in the volume. So volume will be rising with respect to the price will be rising or falling. So in that you can choose impulsive, rising impulsive or falling impulsive. So I have given you one example here. Based on this value of your Davis laboratory, based on this volume parameter, I can say that it is a good candidate for using impulsive rising wave. Same time, we cannot ignore the impulsive falling wave. Impulsive falling wave will act as your stop loss decision. It will act for our stop loss decision as it has come for us. If we have entered, then or we are going to enter 972 level will be our stop loss point or hedging point, with an expectation of wave 5, which will be going for the 1163 level maximum. So this is what you have learned using this Elliot wave, how we can do a short-term investment. So all our softwares are here, all our courses are here. So this is being split into two segments, all our softwares and courses. So these are the 6 different courses based on different objectives we have. Each course is of 2000 post GST. This is the new rate, new pricing of our courses. So all courses, if you are going, it will cost you 12,000. So we have different softwares, intraday positional using one standard deviation, option strategy, GAV, volatility, automated GAN, manual, all these things we have different price. If you want to choose any separate software, you can choose very well. However, if you want combiningly all software except this one, except this number 2, all softwares combined in one platform, then Smart IT, it costs you 8,500. So if I just add these two things, this 2 completes our software. So this cost you 17,000. So full package, those who are buying 12,000 worth of course, what I have displayed, along with this 17,000 worth of software. So what I have displayed here. So together it comes to 29,000. And this 29,000 worth of goods, together if you buy, you are buying at 17,500. We are soon going to launch on Dasera offer. which is going to start from tomorrow for a couple of days. The Dasara offer, I am going to do that announcement. If you are interested in that particular offer, you will be getting 15,500 all stops. So plus applicable taxes will be there, small amount of tax will be there. So if you are interested, then call to any one of this our sales number. So this is the numbers are very given. You can call to any one number. And with the stock scanner and option scanner. Stock scanner and option scanner videos already I have put it in the YouTube channel. You can see those things, and this is enabled here. And now also one more new development has come. This one standard deviation software and the software of Smart IT and 1SD both are available in the Android app. So you can utilize both the things in the Android app also. And with the single license, you can use both. Definitely you have lot many things to learn from us. Our support program, most of you will be knowing what is the support program we are giving. So what is the support program we are giving that most of you will be knowing here. So here, this is the support program you get as a buyer of our product. 2 times we will meet buyer support program, 2nd and 4th week of the Friday, to discuss your issues. You get priority basis invitations to join these programs. So, and you get all your technical queries answered by email. So all these things you can get. Thank you all for joining this program. Thank you for your time. I have tried a great way to explain this difficult concept, very difficult concept of Elliot study in as much as a simplified manner. However, the learning happens at different level.